Welcome to Budget Control. A budget is only as good as its implementation. This module examines budget control. As with our own household budget, we know that if we spend all the monthly paycheck early in the month, we won't have any money left to spend later in the month. Thus, we have to pace our spending as much as possible. The same goes for the organization's budget. In government agencies or grant-dependent organizations, the approved budget has to last for the entire year. We cannot overspend because there may not be any alternative sources of funding at year end. And often we don't want to underspend. This calls for some sort of spending pace schedule. An allotment schedule is where management makes funds available to a department or program on a basis other than annually, such as monthly. This means that in January you'd be given only enough to cover expected spending for that month. If you've exceeded that control level, then you'd have to cut spending out of your February budget in order to make up the funds. Here's an example. It shows the budget progress report for the end of the third quarter of the budget year. We'd expect that 75% of the spending plan would have occurred by now. But it shows that only 66% has actually been expended or obligated by this point in time. The total budget for the Central Laboratory, Chart of Accounts Fund in Division 110101, is $90,900. Actual expenditures to date total $54,469. There are encumbrances, which are authorized obligations against the budget that haven't yet been paid, of another $5,558. The sum of actual expenditures and encumbrances totals $60,027. If we divide $60,027 by $90,900, we get 66%. Looking at the account line items, however, we see significant variance in the percentage spent. The account 5399, non-capitalized equipment, is at 100% of the annual amount. This could be as expected, with the purchase of a single item of $3,000 having been planned. This 66% is less than the expected 75%, so the budget is in good shape. If this spending pace continues, the department is likely to end the year without needing all of their approved budget. Whether this is good or bad depends upon the services performed during the year. Management should look into each item. Did demand fall short of expectations? Or was the cost of providing services lower than expected? Why were salaries less than planned? These are the types of questions that might be looked into in order to understand and plan for the following year's budget. Unanticipated high inflation during a year can make a mess of the budget. Tax receipts may grow with inflation, especially if the tax is on income. Consumption taxes may grow as commodity prices increase. Collections from fixed fees are likely to lag inflation because it may be harder to keep changing the fixed fee rate. The last problem is different from income and consumption taxes, which also may keep a fixed rate, but in their case, the taxable item grows with inflation, thus increasing the collections from those taxes. Annual transfers from governments or fixed grants from donors or others are not designed to keep pace with inflation during the year. So inflation means that those dollars fund fewer services than originally planned. In terms of expenditures, wages and salaries lag inflation unless there are automatic adjustments. Even then, the adjustments are frequently only yearly. So if the inflation expectation built into the annual budget is wrong, you have to wait until the next annual budget cycle to make adjustments. Supplies and services track inflation. Vendors often increase their prices frequently during inflationary periods, so your fixed annual budget is likely to buy less than expected. For these reasons, it's best to consider inflation when building a budget. Countries track inflation by pricing a common market basket of goods and services every month. Changes in what it costs to buy or rent that fixed set of commodities and services each month is then converted into an index. The market basket that cost 100 monetary units last month may cost 110 units this month. thereby representing a 10% cost of living increase. The price index may be termed a consumer price index or a price deflator. Here's an example of how to use an index. In this example, there are 3 years of budget year data: year 2, year 3, and year 4. But realize it could be monthly information if the inflation index is monthly and that level of detail was useful. The budget amount for each of the years is shown, with the year 2 budget at $1,530. The percentage change, calculated from that year to the next, is 1,582 minus 1,530. Then divide the result by 1,530 and convert to a percentage by multiplying by 100, and you'll get 3.4%. But what is the change after inflation is taken into consideration? In this example, the market basket base year was 2015. So the entire basket could be purchased for 100 monetary units then. But in year 2, it cost 118.3 units, or 1.183 times the base year. Now divide the budget amount, termed current, by the index. So that's 1,530 divided by 1.183, with the result being 1,293. Repeating the same process produces the real column, which shows how inflation has dampened the growth curve. The change from year 2 to year 3 represents a loss of purchasing power of 1.3%, despite the current amount of the budget increasing 3.4%. The overall budget change over this 3-year period is not nearly as steep as the current change column shows. As the notes at the bottom suggest, it's possible to restate the price index to a new base year. Annual budgets are premised on expectations of supply and demand. But things can go wrong during the year. As a result, you have to be ready to manage the unexpected events. There may be a surge of demand caused by an epidemic, or you may have more clients or patients than expected. In preparing for that possibility, you should have plans in place to be able to call on part-time providers with the skills you need to operate. You may have to reschedule discretionary visits or client appointments. Managing the queue is critical. This may entail changing the production process to handle more people more quickly without jeopardizing quality. In terms of pricing, a form of surge pricing may be hard to implement. What this would require is for you to manage demand by charging more. The more you increase fees for services, the more likely it will deter people from seeking those services, thereby reducing demand. Of course, this is not likely to work given that those most in need have little ability to pay. As a result, surge pricing in healthcare can raise serious ethical considerations. How do you handle a plunge in demand? A new lower spending level has to be put in place, including freezing purchases and stopping any discretionary spending. What if there is an erosion of service effectiveness due to a loss of skilled staff, for example? In this case, there would be salary and wage savings, but a loss of ability to meet demand, and likely reducing revenue as well. In all of these scenarios, it's best to involve everyone, staff, clients, and the community, in communicating how the agency will make changes. All employees must rally around the changes, with responsibility handed out around the table. Timely reports help ensure that corrective action is being taken and that revised budget goals are on track to be achieved. Sharing this information with the entire staff helps keep everyone moving in the same direction. Regardless of the type of problem that has emerged, whether it's due to a surge or a plunge, the lesson is to improve the organization's ability to balance supply and demand going forward.